All right, let's talk about ISEC Healthcare's latest report. There's something interesting going on here, a real puzzle, actually. Their sales went up, which is good, but somehow their profits went down. So we're going to dig in piece by piece and figure out exactly what's happening.
Okay, so here's how we'll tackle this. First, we'll look at the two big numbers everyone cares about. Then, we'll play detective and follow the money to see where those profits are disappearing. After that, a quick checkup on the company's financial health, a peek at their future plans, and finally, we'll weigh the opportunities against the risks. Pretty straightforward, right? Let's get to it. All right, first up, a tale of two numbers. When you look at any financial report, there are usually two big figures that give you a quick snapshot of what's going on. Let's see what those are for ISEC.
So, for anyone who's not familiar, who is ISEC Healthcare? Well, they're a specialist in medical services, particularly eye care. They have a really big footprint in places like Malaysia and Singapore. And the numbers we're looking at today are for the first 3 months of 2026.
And right here, this is the puzzle I was talking about. On one hand, you have revenue, the total money coming in, up by 4%. Hey, that's great. More sales is always good. But then you look at the profit, the money they actually get to keep after all the bills are paid, and that's down by 11%. See the disconnect? This is what we need to figure out.
So that really is the million-dollar question, isn't it? If they're selling more of their services, how on earth are they ending up with less money in their pocket? To get to the bottom of this, we've got to follow the money.
Okay, let's start tracking that money. This is where we figure out exactly what's putting the squeeze on their profits.
Now, before we get to the raw numbers, let's quickly talk about a key idea: cost of sales. Honestly, the best way to think about it is with a bakery analogy. Imagine you sell more bread than ever before. Great, right? But what if the price of your flour and sugar goes up even faster than your sales? Well, you'd end up making less profit on each loaf. That's exactly what cost of sales is. It's the direct cost of providing their services. And if those costs climb faster than sales, profits get squeezed. And boom, this table just lays it all out crystal clear. Look at that top line, revenue. It went from about 17.9 million up to 18.6 million. That's that 4% growth we talked about. But then, look at the very next line, cost of sales. That jumped from 9.8 million all the way to 10.8 million. That's a much bigger jump. 11%. That's the number that explains everything. Their costs shot up by 11%. Think about that. Their sales grew by 4%, but the costs to make those sales grew almost 3 times faster. That's exactly where the profit is going. The rising costs are just gobbling up the extra revenue. Okay, so we've established that profits took a hit this quarter because of rising costs. But that's just a snapshot in time. To get a real sense of the company's overall stability, we need to check its financial health. And for that, we look at the balance sheet. It's kind of like a financial checkup for the company. And the results of the checkup? Well, they look pretty darn good. You see here that their total assets, that's everything they own, are worth over $145 million. Now compare that to their total liabilities, that's what they owe, at just over $38 million. So they own way more than they owe. And maybe the best part? Look at that cash line. Almost $23 million sitting in the bank. That's a really solid cushion to have. Having a strong financial position like that, with plenty of cash, gives a company a lot of options. And it looks like ISEC is choosing to use that strength to invest in its future. So let's take a look at what they're building. They've got a couple of big things in the works. First, there's a brand new medical center being built in Kuala Lumpur. Construction is done, they're just renovating now, and it should be open by 2027. And second, they've kicked off a new joint venture in a place called Batu Pahat in Malaysia, which basically expands their reach. These are both pretty big moves, designed to bring in more business down the road. So what we're seeing is kind of a mixed bag, right? Profits are down in the short term, no doubt, but the company is financially solid and they're making big investments for the long term. So with that in mind, let's pull it all together and look at the path ahead, the opportunities and the risks. Now, with any company, there's always something you can't quite control, a wild card, you might say, an outside risk that they're keeping a close eye on. So what's the biggest one for ISEC? It's all about what's happening in Myanmar. The company is very clear that their medical center there is up and running, but they use this specific phrase, the situation remains fairly uncertain. Now, when a company uses language like that in a report, that's a signal to investors. It's not a red flag saying something is wrong right now, but it's them openly saying, hey, keep an eye on this. It's something we're watching too. Okay, let's boil this all down. What are the big things to remember? 1, sales are up. That's a good thing. 2, costs are up even more. and that's squeezing their profit margins. 3, they're financially healthy and using their money to build for the future with new medical centers. And 4, keep an eye on the situation in Myanmar. It's the one big uncertainty. So yeah, it's not a simple good or bad story, but now you've got all the main pieces of the puzzle. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.